Hello, YouTube. It is John. Today is June 25th, 2025. After action market report here. So, over the next couple months, expect to see significant inflation well above our 2% benchmark. And these people at the Federal Reserve are going to bemoan that fact and act confused why it's above that 2%, like they aren't the ones causing it. And the same deal with Congress there. But that's one thing we're dealing with. The other thing we're dealing with is part of a potential recession I see forming here. And I've kind of wrote down like a decision game theory matrix of what happens and the potential results all around. And either path this decision matrix goes down, it doesn't look pretty. But I'll jump into it here. So President Trump and Vice President Vance are pressuring for lower interest rates from the Fed. And we saw yesterday Fed Chair Powell go before Congress and claiming that he's keeping rates high because inflation is still high. Like, the Federal Reserve isn't the one that's ultimately responsible for it, and Congress as well, which is just completely and utterly ridiculous. So, central banks issue debt. To sum it up, central banks issue debt through currency, and they buy it back via debt. And they do that to increase money supply and suppress interest rates. This is kind of economic theory, straying into the more advanced stuff, but the idea is that it stimulates the economy, but it also has the secondary effect of increasing inflation. So when you see Federal Reserve Chair Powell testifying in front of Congress saying, "Well, inflation's still too high, and like I can't move rates around until inflation gets under control," they're the ones causing the inflation. In Congress too, through massive deficit spending. Republican or Democrat, whatever party's in charge, they get in there and they spend trillions of dollars. And then the Federal Reserve, through this kind of shadow quantitative easing, is also issuing trillions of dollars of currency into thin air. And they're the ones they're why inflation isn't at the 2% mark. But ultimately, if they stopped, the entire stock market would come crashing down. And that's one thing to cover here. The stock market and the economy have completely decoupled. Now, I was talking to a friend about 2 months back, and this was when the market was coming down, and he was saying, well, the economy is doing so bad right now. And it's like, I was like, what's your proof for that? Not to say that the economy hasn't been in tatters for a long time, but I was genuinely interested in like source, and he pulled up the S&P 500 and he showed it to me, and he was saying, "Look, the line's down, the line's down." It's like, that's not the economy. You know nothing of. I love him, but he doesn't know anything about the economy. You can't make this stuff up. It's 9 out of 10 people don't really know or don't even know that the economy and stock market have completely decoupled. They think the S&P 500 and the Dow Jones Industrial Average or the Nasdaq is a measure of the economy. It's not. It's not. And if you don't believe me, look at look at, look at COVID-19 back in 2020 when they shut they shut the entire country down and the stock market went up. Does that make That's what I mean when I say the S&P 500 is not it's not indicative of the economy. It's speculation. Sometimes it's loosely correlated. Oftentimes it's just completely out of whack. But anyway, going on from that, we saw NATO wanting to increase. Where is it here? Pull it up. NATO. 5% defense target. The NATO 5% defense target here was just recently announced. Here we go, CNBC. Pull this one up for you here. So June 25th, 2025, NATO allies agreed to higher 5% defense spending target. And pretty short article. But President Trump met with NATO allies, and I suppose the European countries are afraid of Russia, but they all came together and said they're going to raise their defense spending targets to 5% of their GDP. Now, why is that important? It's because how are they going to pay for that? Do you think they're honestly going to budget, take an honest accounting of their national budgets, and say, oh well, we need to increase 100 billion of defense spending here, so we're going to cut 100 billion there? No, they're just going to print the money, and it's going to be more inflation. Does anyone honestly think that inflation will decrease with that? No. No. Why would anyone think that inflation would do anything but go up when you set an ambitious goal like that? That's not even the most ambitious goal of spending. There's other stuff to go off of, but it's maddening, some of this stuff. One more thing I wanted to cover today, or the second to last thing here. So platinum has seen a big run up recently, and it was sitting about 1,000 at the beginning of May, and recently it's about 1,400 now. So a big increase over the last, call it 1 month here, 27% increase. Over the last 3 months, 44% increase. Now, part of that is platinum catching up with the other precious metals. Gold has seen a huge run up. Earlier, silver, same deal there, and platinum's lagging a little bit behind. Palladium to a lesser degree, and the mechanism behind that is with palladium and platinum, they're both important components in car manufacturing, so the car producers will take whichever metal is cheaper, say for catalytic converters where platinum or palladium can be used because of their thermal properties, and they'll switch them out depending on whichever one's cheaper. So if platinum is super expensive, they'll retool all the factories to use palladium to build catalytic converters, which is what we saw over the last few years, which is why palladium had a huge run up. And then when palladium becomes expensive, they'll go back to platinum and retool their factories for that. So platinum, in my view, will continue to rise for the foreseeable future here until it becomes not economical to use anymore, and they'll switch back to palladium. But anyway, the last thing I wanted to cover here today was collateralized loan obligations. So I was kind of organizing my logic on this here, and you have private equity. To basically recap in a very condensed version of what's been happening over the last 5 years, private equity and private capital, or private credit rather, have used leverage buyouts to acquire trillions of dollars of companies. That was back in the 2020s when rates were low, but this was all adjustable rate corporate debt. And on top of that, it's not like these private equity companies just held onto that debt themselves. They saddled the companies up with the repayments of that debt, and then they packaged off that debt and sold it off in collateralized loan obligations, which functions exactly similar or exactly the same as collateralized debt obligation from 2008 with mortgage-backed securities. And they sell that off to pension funds, endowments, etc. And the kind of linchpin here that we're dealing with, though, is that's all adjustable rate debt. So we've seen a slew of bankruptcies recently with companies acquired by private equity because they're paying upwards of 4%, 5%, 6% on some of these loans, and they pretty much can't handle it anymore. But these collateralized loan obligations, compared to other debt investments, have been yielding a lot higher rates for investors, which makes them attractive. But the danger here is that a lot of the pension funds and endowments are kind of waking up to that, and they're selling off these kind of just garbage loans. So there's a Bloomberg article out earlier today saying how one of these big 20 billion CLO funds saw a $600 million outflow recently, which, combine that with private equity doing some shady deals where they're setting up secondary investment companies to repay the first round of investors, kind of in a Ponzi scheme to tread water until rates are lowered again. You'll see these CLOs being marketed out to retail investors because they're looking for, a lot of these institutional investors are going to be looking for exit liquidity here. They want someone to hold their bags while they run to the doors and light the movie theater on fire, metaphorically. And don't let yourself be tricked. Don't look at these and see the very high interest rate and think, I'm going to invest in these. It's the interest rate on this corporate debt is high for a reason, because it's garbage. It's a dumpster fire. The reason the rate is so high, in economics we go over this. You take the yield of a corporate bond, say it's 5%, and the yield of a treasury note, say it's 4%, and that 1% differential is called the credit premium. Gosh, I'm drawing a blank. I studied it in college. Credit premium, or credit risk. I can't remember now. But it is the measure of how risky that corporate debt is. And if a corporate bond is yielding 10% and rates are in a treasury note is yielding 1%, that's a very dangerous corporate bond, because it means the people who issued that debt want that money back as fast as they can before, or taking into account that the company might go bankrupt. But anyway, there are two paths here going forward with these collateralized loan obligations. Path one is that the private equity is kind of trying to tread water with this Ponzi scheme they're running right now of getting new investors in to repay old investors. And case in point of that, this is an article today. Newly tokenized Janus Henderson CLO strategy sees $1 billion inflow. And this is from Decentralized Finance Crypto to basically get more liquidity into these garbage assets. And this is part of the Ponzi scheme. If you're somehow involved in that, your money is getting sent to original investors in round one who want their money back, and you're going to be left holding the bag. But with that backtrack aside, we have two paths going here. Path one is the Fed doesn't lower interest rates for whatever reason, because inflation stays high, because they're making inflation stay high. But say the Fed doesn't lower interest rates and these companies that private equity has saddled with all this debt start to go bankrupt. We've seen that with Red Lobster, but it looks like they're coming out of bankruptcy now. I'll have to verify that. Hooters, Joann's, bunch of other companies. If those companies go bankrupt because they can't make their exorbitantly high interest payments because this debt is adjustable rate, then the CLOs are going to go to zero anyway. And path two is, say the Federal Reserve lowers interest rates. Well, these CLOs are adjustable rate loans. So if the yield on these CLOs go down, and say the overall stock market has better investment opportunities because now rates are lower, companies can take out cheaper loans, expand business. then why would anyone invest in these CLOs to begin with? The flip side of that is the Federal Reserve is lowering rates because there's a recession. In which case, there's a recession. Do you think these companies that are on the verge of bankruptcy will survive in a recession, even if their debt is lowered? No, they're not. Even if these companies are already skating on thin ice here, it doesn't matter if you take away their debt or lower it substantially. If there's a recession coming, then they're doomed anyway. And this entire market is $3.8 trillion large, which compared to 2008 with the collateralized debt obligation market, that was $1.3 trillion large. So the problem is 3 times as big. In 2008, we had, on top of the $1.3 trillion CDO market, $20 trillion in derivatives based off those CDOs, say credit default swaps or synthetic CDOs. And there's no way to know how big the derivatives market is on this, but it's like I was saying a couple of videos back. The problem is 3 times as big. If it's half as bad as I think, it's still worse than 2008. But anyway, that's the video for today. Overall, market's a wash. It's funny to see over the past few days when it's looking like there's going to be a war with a ceasefire, and we'll see if it holds, but it's looking like there's going to be a war. The market skyrockets, and when there's no war, the market flatlines. I thought that was funny. But anyway, going on from that, that's all I have for y'all today, so stay safe out there, and I'll see you tomorrow.